This is not numerical. Numerical means it's a case study actually. The same case study you get it in the exams. Similar, exactly the same many times. So, on one, here it is from your textbook only. Yeah? So don't worry, it is not out of your textbook. So there are more chances of these case studies coming in your exam. On 1 June, customer requests to book a forward contract for retirement of import bill for USD 1 lakh due for payment on 15th September. Given the spot USD INR rates as 75.2729, forward premium as given as spot for June is 10 to 12, spot for July is 21 to 23, spot for August is 30 to 34, spot for September is 43.45, and August to 15 September it is 6.7. So charge the margin of 0.2% on the spot rate. So how to solve this numerical? Such a big numerical. This numerical will be for 5 marks. They'll ask you various questions in this. Very numerous questions. There can be many questions which can be asked from this. But once you are clear in the concept, you can definitely solve all the questions. So firstly, what is it? Forward contract. Okay, forward contract means, immediately remember, it must strike your mind that whenever we say forward contract, I'll mark this line over here because my video is over here, right? So whenever I say forward contract, it means forward contract. It means I'll have to use the forward rates, bill rates. Remember this, bill rates. Okay. This is something you must always remember. Whenever I'm talking of forward contracts, I'll have to use bill rates. Okay. Whenever I'm talking of spot transactions, I'll have to use TT rates. Here, I'll give you the classification over here. Spot transaction, you'll have to use the TT rates. Okay. Now, if I'm talking of import transaction, import, okay, import, then I'll have to use which rate? I'll have to use sell rate, sell. If I'm talking of export transaction, export, I'll have to use buy, okay, buy rate. Always remember, only in case of crystallization, it's reverse because crystallization is actually the reverse case. But don't worry about crystallization in this case study now. So import we are talking of sell, export we are talking of buy, forward we are talking of bill rates, spot we are talking of TT. Okay. Now I'll ask the questions also to you. Not only I'll answer, but I'll ask the questions also. Now based on this, tell me this contract, what is given about this contract over here? On 1 June, the customer books a forward contract for retirement of import bill. Retirement of import bill means what? The customer has to pay that import bill, pay to that customer. And that payment is to be done when? On 15th September. So this customer has come to you when? This customer has come to you on, okay, let me draw it on the other page. Let me see. But before going ahead, everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, remember, you will be getting the latest updates from IIBF on JIB and CIB. Updates means they give various notifications. This subject change, that subject change, this portion change, this timing change, this venue change, all these. So these are immediately updated on this this channel. Number one. Number two, what you will be getting is very importantly. So yeah, you will be getting the free YouTube series on all the subjects, free YT series, okay, of CAIIB as well as JIB. So join it immediately, and whatever is free, grab it fast. Click on the bell icon, click on the like button, okay, share it with your friends, okay. Chalo, let's start this numerical. See, it is, what is the numerical actually? See this, I'll draw it over here. Firstly, let me draw a line over here. Otherwise, what happens? It goes behind my video, okay, here, okay, now. Yeah, so this is what June 1. Now the customer has come to you for booking the contract for what? September 15th, isn't it? Look at the date. September 15th due date. So September 15th means you'll have to book this September 15th over here. Let's mark it September 15th over here. So this customer will have to pay to this his buyer, his seller on September 15th. He is booking the contract today. Okay, so I'll have to book for this gap. This is known as a forward transaction. Okay, now September 15th will come in between what? September 1 and September 30th. So September 1 and September 30th. So everyone amongst you will think now we'll be doing this buy low sell high rate over here, but we won't be doing it over here. No buy low sell high over here. Remember, those who are thinking, those who have learned something, buy low sell high maximum, they are using it, don't use it. Okay? Why don't use it? Because the reason is the rates are already given over here. Look at this. If you look at the forward rates, it is given this last rate is August to 15 September. So exact rate is available for 15 September. So when exact rate is available, you need not do buy low sell high. Buy low sell high is done when the rates are available of September 1 and September 30th. But you don't know the exact rate of September 15. Then we'll do buy low sell high. But here we have the exact rate of September 15. It's already given. So now get the forward rates of this forward rate we want, exact forward rate we want it now. This one. How to get this? Start from June. Okay, whatever we have, start from the basic. What is the June rate we are having? June spot is given as 75.2729. Now I'll ask you the question. Okay, is it 75.27 or 75.29? What will I take? 75.27 or 29? What will I take, everyone? Should I take 27 or 29? It is import transaction. Fast. Let me see in the comment section. We don't have time. It is 75.29. Import. Import means sell. So sell means right side. 75.29. Okay, this is the rate I will be taking. Okay, now I want September 1. What is the September 1 forward rate? Are you having it? See, the spot is given for June. Now, whenever I say June, it means June end. Remember this. Whenever I say July, it's end. August end. Okay, September end. Okay, so this my transaction is on September 15th. So I can't use this September end rate. I'll have to use the August end rates here. August end equals to here. August end. It's equal to September 1. September start. Okay. This is like the closing cash and opening cash of your bank. What is the closing cash for yesterday is the same as the opening cash for today, isn't it? Volt cash. So same logic is used over here. So August end equals to September start. So I want it for September 1 now. So that will be August end rate. So I'll be taking 32, 34. Which one will I take? 32 or 34? Should I take 32 or 34? I'll take 34, right? So now tell me this is 34. Okay. Now tell me whether the currency is in premium or discount over here. Everyone type in the comment section 10, 12, 21, 23, 32, 34. So is the currency in premium or is it in discount? What do you say? It's in premium. Remember, when your right side is higher, right side is big. Okay, in forward transactions, the currency is in premium. Always remember this, premium. When your right side is big. So vice versa is also true. When the right side is small, it is in discount. And whenever we have premium, we'll have to add the forward points. Always add. Okay. So now it is in premium. I'll have to add it. But see this, 34 I'll do it. I'll take this 34 now. Oh, over here. I'll take this 34. So what is my rate now? 75.29 plus 0.34. Take this point. So what is the answer now? 75.29 plus 0.34. So what is the answer you're getting? It is 75 point what? 75.6 and 3. 75.63, right? Add this. How many of you have got this? 29 plus 34. 33, 43, 53, 63. Isn't it? This is one. But I want it for September 15th now. So what will I do? I'm having this rate up to September 1. I'll take the forward points for September 15th now. What are the forward points given? 6 and 7. Okay, this one. 6 and 7. Seeing this? 6 and 7. So what will you take now? 6 or 7? Everyone type in the comment section. You will take 6 or 7. I'll take 7 because sale. But I won't take only 7. It is 07. 0.07 because we require after 0.2 digits. So 0.07. So what is this now? Again, premium or discount? Premium. So I'll add this. So it will be 75.63 plus 0.07. So 75.70. This will be my rate for September 15, exact rate for selling. Okay, selling. But is this a final answer? No, this is not the final answer. Why? Because I have to charge this margin also, TT margin. Where is it mentioned? We have not mentioned anything about the TT margin. So what is the TT margin then? Say this TT margin is always taken like this. Whatever rate you get, 75.70 into what is that? 0.2%? What is it given? 0.2%, right? So 0.2 upon 100. 0.2 upon 100. So what is the answer you're getting? Try it on the calci, everyone. Everyone should be able to do this now. Fast. Everyone should be able to do this. Fast. Try it on the calci. What is the answer you're getting? Everyone. Yeah. Let me also try along with you. So 75.7 into 0.20. So 0.02 you can write it, or you can divide it by 100 later. So it is, what is the answer you're getting? You're getting 0.1514, right? This is the answer you might be getting, right? 002. So 0.002 into this. So 0.1514 you are getting. Are you getting this? Everyone type yes in the comment section if you are getting it. Are you getting the same answer? Okay. Chalo, move on. So this is my margin. So what to do with this margin? Remember, whenever you are selling, you'll always add the margin, TT margin, huh? And whenever you are buying, you'll always subtract the margin. Okay. So now what am I doing? I am doing the import transaction, means selling. So I'll add this. So what will be my final rate now? 75.70 in plus 0.1514. So what is the answer you are getting? Add it. So let me see the answer from your side. It is 75.7 plus 0.1514. Everyone tried 75.85. 75.8514. This is the exact answer you will be getting. And this is your final answer. Okay. But what do you mean by this rate? What has happened actually? In this whole transaction, you have got the rate. But what has happened? This much amount you will be debiting it to the customer. See this 75.85, because $1 lakh are to be given. So what amount will you be debiting to that customer? So 75.8514 into 1 lakh. $1 lakh, right? 1 lakh. So whatever that amount is. So it is around 75 lakhs, right? That much will be the amount, isn't it? Yeah, into $1 lakh. So multiply this. So you'll get something 75.8514 lakhs. This much amount you will be debiting to the customer and then passing on the $1 lakh to the next party in foreign. Okay. So this was the actual case study. In exam, how will they ask you? They'll ask you various questions. They'll ask you, okay, what is the spot rate for June to be taken? Okay, what is the September 1 for this forward rate? What is the September 15th forward rate? Will you be using buy low, sell high in this exam, in this question? So these all questions will be asked to you and you must be prepared for that. For that, you must have studied this case study. Okay. Before going ahead, everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, everything you'll be getting. Okay. Whatever we need for clearing JIB and CIB, we get it over here. So that's why everyone download this app immediately and start studying. Okay. Second numerical. Now this is not a simple one, a confusing one, but let's see how many of you can answer this. A forward purchase contract USD 5 lakhs booked 2 months back at 75.25 is due for delivery 2 days later. The customer is informed by the drawee of the bill that the payment will be delayed by 1 month. Now this much is your case study. See here, there is a contract which was booked, okay, 2 months back. Means I'll write it over here. Say this. 2 months back, there was a contract which was booked for due for tomorrow. Means here, let's say tomorrow. Okay, here it is tomorrow. So 2 months back. What is this month now? Let's consider anything. This is September. Okay. So gone August and July. So July, let's say the contract was booked. It is due in September. This tomorrow's date, let's say. But what has happened is customer is told now by his buyer. See here, forward purchase contract. This is a purchase. Purchase means it's an export transaction. Always remember. Purchase is always export. So this buyer has told, buyer means what? The buyer of your customer. That buyer was going to pay the customer on September. But this buyer has said that no, I won't be able to pay you now. I'll be able to pay you after 1 month. So I'll be able to pay you in October. Now what have you to do? In this case, what have you to do? This contract was already here. This is contract number 1. So this contract number 1 was booked over here. Okay. So if it is booked, it has to be nullified over here. Cancelled over here. Cancelled. See here, the rule is very simple. Whatever is booked has to be cancelled, or either it has to be paid or it has to be cancelled. So if it has to be cancelled, it's like the same rule. जिसको आना है वो जाएगा, right? Simple rule. The one which rises will always fall. The one which is booked will always be cancelled or paid. It will be equated. Okay. So this is to be cancelled. But remember, if it is to be cancelled, it doesn't mean because the payment is to be received in October. Is the payment received up till now? No. Payment is not received. So what will I have to do as a banker? Now the role of the banker comes in. The banker will have to cancel transaction number 1 and will have to book a new contract. Book new contract for October, this 1 month. Because up to the time payment is not received, the transaction is not over. Okay. So the bank will have to do 2 transactions over here. One is cancelling the older one and booking the new one. Okay. Now let's look at it. So rate of booking of the original contract means when it was booked in July. At what rate was it booked? TT buying rate. Okay, let's consider this ABCD. A, B, C and D. So now, when the contract was booked in July, at what rate was the contract booked? TT buying, TT selling, bill buying or bill selling? What do you think? Purchase contract. Purchase means what? It will be buying. Okay. Purchase means buying. Buy. So if it is buy, then what? Now the answer is only 2. 2 are remaining. Either TT buying or bill buying. So which one? Just now I told you in the first numerical. Whenever you are booking a forward contract, you will always use which rate? Bill rate or TT rate? Just now, just go to the part of that video again. You will be taking bill rate. So the answer will be bill buying. So the original contract was booked at bill buying rate. Remember this. This bill buying rate is 75.25. Okay. Second question. The rate of cancelling the original contract is what? TT buying, TT selling, bill buying, bill selling. So cancelling, this cancellation means this. Cancelling transaction number 1, this one. This is to be cancelled when? It is due when? Tomorrow. Tomorrow means spot. Always remember, this is spot. So here I'll have to first use spot. Spot means what? Whenever we are doing a spot transaction, which is to be rate is to be used. Again, first problem. Just now I gave you. Spot you have to use in the comment section. Let me see. Spot you have to use TT rate or bill rate. Okay, I'll give you options. TT or bill. So which rate will you use? TT or bill? TT rate, correct? So TT is okay. So now these two are out. TT is only in. TT buying or TT selling. Now I'm cancelling the contract. So if the contract was booked at what rate? It was booked at the buying rate, right? So originally it was booked at buying rate. So cancellation will be done at what rate then? Will it be buying or selling? So if I do something at buying, I'll have to cancel that using selling, right? So I'll be using bill, this TT selling rate, right? So the answer will be TT selling rate over here. Okay, cancelling is always done at the reverse rate of the booking. Okay. Then you'll say, why not bill booking, bill selling then? But because bill selling is not used. Bill is used whenever you are doing some future dated transactions. Here I am cancelling tomorrow itself. So it is a spot transaction. So TT, isn't it? A rate of booking the new contract for next 1 month. So next contract will be booked at what rate? TT buying, TT selling, bill buying, bill selling. Who can give the answer? New contract for 1 month now. Simple logic. You have the answer only here itself only. You have the answer here. Let me see the simple logic you can give. See here, contract number 2 which is booked is same as contract number 1. Because there also I had booked it for purchase. Again I'll have to book it for purchase because same thing is repeated. This full whatever had happened in July is repeated on over here now. Same thing is repeated. So if it is repeated, then the rates will also be repeated. So it will be again bill buying rate. So I'll be using bill buying rate. But the rates will be different. Of course, not the same rate. But the logic is same. I'll be using the bill buying rate only again. Okay, new contract. Of course, the rates will be for today, whatever the rates are. Okay. So this is what you need to understand. This is the crux of the problem. Cancelling this at spot rate or TT rate, booking the new and the original logic again, bill buying rate. But the rates over here will be different than the rates over here because this is today's situation. This was July's situation. The liquidity risk of the bank arises from. So liquidity risk of the bank, of any bank. Liquidity means what? What do you mean by liquidity risk? It means that I don't have money at right time. That is very important. At right time, whenever I have to pay my EMI, I don't have money. That is a liquidity risk. Same thing about the banks also. Bank has to pay some bond holder. Okay. At that time, bank doesn't have the money. That is liquidity risk. If some depositor comes for withdrawal, bank doesn't have money. That is a liquidity risk. So this liquidity risk of the bank arises from number 1, funding of long-term assets by short-term liabilities. Long-term assets by short-term liabilities. What do you mean by this word? Suppose let's consider all these cases. Okay. Let's consider all these cases. Let's say this is deposits. Here, liabilities means deposits. Assets means loans. Okay. Now, case number A. Funding of long-term assets by short-term liabilities. Means what? I'm having a deposit of 1 year and I'm giving a loan of 3 years. Will this create a liquidity risk for me? Just type yes or no over here. Let's see later. B1. Funding of short-term assets by long-term liabilities. So deposit of 3 years and loan of 1 year. Will it create a problem for me? Funding of long-term liabilities by short-term assets. C. Funding of long-term liabilities. This is ab initio wrong. This is from start only wrong. Why? Liabilities funded by assets. Is it possible? Not at all possible. Assets are always funded by long-term liabilities. Means long-term or short-term. Assets are funded by the liabilities. So C is ab initio wrong. Okay. Ab initio means from the start itself. We need not even discuss this. That is the point. Now the question lies between A and B. Between A, 1 year deposit I am having and 3 years loan I have given. So will it create a problem for me? Yes, it will create. Why? Because this guy who has deposited, this person will come to me after 1 year, but this person will pay to me after 3 years. So this will be a problem to me. What about B? If this person has given me a deposit of 3 years, this guy will come after 3 years. Isn't it? This guy will come after 3 years, but this guy will pay me immediately after 1 year. So I won't have any liquidity problem over here because whenever this person comes, I can repay him back, him or her. Okay. So the answer is A. Funding of long-term assets by short-term liabilities. This is a basic logic based on which this question is dependent. And such questions are asked to in exam. Remember. Okay. Move on. Funding liquidity risk is defined as funding liquidity. Remember this. Funding means I don't have funds. Liquidity risk, but related to funds. So that is defined as excess of liabilities over assets. Excess of long-term liabilities over long-term assets. Excess of short-term liabilities over short-term assets. Inability to obtain funds to meet the cash flow obligations. Very simple definition. Excess of long-term liabilities or long-term assets. Is this a liquidity risk? Excess of liabilities means more of deposits, less of loans. Obviously, that can be the answer. Similarly, B can also be the answer. Look at this. All the answers seem to be right. All of them. You check this. All of them seem to be right. Liability is greater than assets here. I'll show you over here. Liabilities greater than asset. In all the cases, logic is same. Okay. Liabilities are greater than assets here. Over here, excess liabilities over assets. Here, long term over long term. But after all, the same. Liabilities and assets. Short term over short term. Logic is same. Liabilities over assets. So logic is liabilities are more than assets. So definitely that is the answer. Whenever I have deposits of let's say 100 rupees, okay, and loans of let's say 70 rupees, okay, so will it be a problem for me as a bank? Do I have a problem in this case? Okay, just check your bank's ratios, your bank's loans and asset deposit ratios. Is it always 100? Let's say this is 100, this is also 100. Is it always 100? No. RBI has given the term as your liabilities and assets should always be 70%. So this is right. Okay, assets will always be lesser than your liabilities. Always. Means basically loans will always be lesser than your deposits. Of course, the ratio is matched so that the rate of interest NII is not affected much. So the correct answer is this: inability to obtain funds to meet the cash flow obligation. That is the correct answer. Okay. So funding liquidity risk is defined as inability to obtain funds to meet the cash flow obligations. Okay. Liquidity risk in banks manifests in different dimensions. Which are these? What do you mean by this? Manifest means comes. It comes in various ways. Okay. It comes in various ways. Dimensions means ways. Let's keep words simple, isn't it? So liquidity risk in bank comes in different ways. What are these? Funding risk arises from the need to replace net outflow withdrawal and non-renewal of deposits. It can be. Just answer. Think over it and answer. Fine. Here, CAIIB is not like JIB. Just you got the answer, tick it. No. Here you have to think. Funding risk arises from the need to replace net outflows. Non-renewal of deposits means whatever is going out, that needs to be replaced. Suppose if tomorrow there is a huge withdrawal from your bank, run on the bank, we call it run on the bank, right? Anyone knows run on the bank? What is run on the bank? Type in the comment section. Okay, just type, do you know run on the bank concept? Type yes or no, only that much type it. Yes or no, yes or no, only that much. Don't give me run on the bank definition, it's a big definition. Yeah. Yes, no, yeah, some no's I am seeing. See here, run on the bank means when all the customers of your bank, remember whatever I am saying, when all the customers of the bank come for withdrawal of deposits, all of them. So that is known as run on the bank. There's some negative news in the newspaper, something wrong about your bank. So everyone comes for withdrawal. That is run on the bank. So coming back to the question, withdrawal. Outflows, withdrawal. So we need to replace these withdrawals through fresh funds. So liquidity risk may arise from this also. Number 2, time risk arises from the need to compensate for non-receipt of funds, NPAs. Means basically, suppose if I've given a loan, so what is my logic? The logic says that that person will pay me the EMI, and or CC if given that person will pay me the interest, and that interest I'll use it for paying to the depositors. But if I don't get that interest, don't get that EMI, then what? So that will also create a time risk. Time risk means what? At the time, I'm not having the funds. Call risk arises due to crystallization of contingent liabilities. So call risk arises from crystallization of contingent liabilities. Contingent means what? Contingent means which was not to come. or future transactions, future, like bank guarantee, LC. Okay, these are all contingent. So it comes in which of these cases? Both A and B. Okay, I'll mark it like this: A, B, and C. That is the best answer. So the answer is actually this: A, B, and C. Because funding risk is to replace the net outflow, that is also correct. Time risk is for compensating the non-receipt of fund, that is also correct. And call risk is also a type of risk, this liquidity risk only. Because if tomorrow there is a huge bank guarantee to be paid by you, then from where will you get the funds? Urgent funds. Okay. So both, both, actually it's A, B, and C. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting latest updates from IIBF on JIB and CIB. Means what is updates from IIBF? IIBF gives various notifications. Like now it's exam time, so it will give certain notifications that this exam time changed, that exam time changed, this subject's portion is this, something has been added over here, something like this they'll give. So these notifications are explained on this channel immediately. Officers Adda 24/7. Also you get free YouTube series. Here right now what are you watching? You're watching the same free YouTube series. So you get a free YouTube series on the channel for all the subjects of JIB and CIB, all. Okay. So that's why subscribe to it, click on the bell icon, click on the like button, share it with your friends. Okay. When an asset maturing in where an asset is maturing in 2 years, the liability risk will be, suppose if any asset means loan is maturing in 2 years. Okay, 2 years means what? I have given a loan and that guy or girl will be paying me after 2 years. Okay, so what is the liability risk? Now look at this liability risk. Means what risk will I face from the depositor's angle? Basis risk, yield curve risk, gap risk, embedded option risk. From the depositor side, I'll face this risk, depositors, embedded option, right? See here, if this asset is maturing in 2 years, means there is a loan. Let's look at it this way, loan. Okay, if this loan is maturing in 2 years, this deposit, I may face a deposit. Here, I have to fund this loan by this 2 years. So what I have to fund is, I have to see to it that I have sufficient deposits for this loan. But if these deposits get matured, FD gets matured, there's a withdrawal, then will I get the same FD of the same amount afterwards? If after the withdrawal, will I get the FD of the same amount at the same rate? That is known as embedded option risk. Embedded means what? Anytime it can withdraw. Suppose if I need this 1 lakh rupees over here and this 1 lakh is withdrawn from here, depositor's angle, then my balance sheet is in a problem. So embedded option risk means there is a chance of withdrawal of FDs, withdrawal of savings deposits, plus there is a chance of repayment of these loans also. Now this is from the loan side. Somebody repays these loans. So embedded option risk is for both the sides, loan also and deposit also. Here we are talking of liability, deposit side. So that's why it's a main embedded option risk. The risk of adverse variance of mark to market of change in the market price of the interest rate instruments, equities, is called. So mark to market, what is mark to market? Mark to market means that basically the logic behind mark to market is, suppose if I brought let's say a bond, and that bond I am not going to sell immediately. But mark to market means what? Whether if what is notionally I am gaining some profit or not in that. That's the meaning of mark to market. Suppose if let's say you have brought a flat, you have purchased a flat, okay, for staying flat you have purchased. Now this flat you won't be selling it now because you are staying in that. But you get the daily rates for this. There are certain brokers who come to you, sir, the flat right now you had brought it at let's say 30 lakhs. Now the flat is giving you around 50 lakhs. So this is what this difference is known as notional or mark to market. Notional or other name is mark to market, M to M. Okay, M to M means what is the rate at which I had brought and what is the present value of my security. Okay, So risk of adverse variance of mark-to-market value of change in market price in the interest rate instruments. Interest rate instruments is called as price risk, market risk, translation risk, both A and B. What is the answer? Let me get it from you now. I'll explain you, not an issue. But let me get it from you first. It is both A and B. Price risk and market risk, both. Because here, market price risk is actually a part of market risk. And price risk arises because of the interest rates. If the interest rates go up, interest goes up, interest rate goes up, then the price of the bond will go down. Price will always go down. Price. Okay. So this is basically the logic behind this. Which of the following is not a market risk? Not. Okay, not a market risk. Compliance, transaction, legal, all of the above. Let me think. Type fast in the comment section. Which of the following is not a market risk? Not. Market risk means what? What is a market risk? Market risk means that risk which is not in your hands. Not in your hands. Okay, keep it very simple language. Okay, not in your hands. Russia-Ukraine war, not in your hands. Then the COVID situation, not in your hands. Right? RBI changing the repo rates, not in your hands. So this is all market risk. So which of the following is not a market risk? So compliance risk. Compliance means what? Submitting the returns or submitting the consent documents to RBI. It's in your hands. You have to follow the compliance. So it is not in your hand, right? Not a market risk. So it is, I'll write it not a market risk. N. Transaction risk. Transaction means whatever transaction I'm doing, I must maintain precautions in that. So there's no market risk. External forces are not acting on this. Legal, again, it's a part of this transaction risk only, right? Means basically operations risk. These are all operations related risks. So this is not a market risk. Answer is all of the above. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests. Whatever we require for clearing JIB and CAIIB, we get it over here. So that's why download it right now, immediately, and start studying. Don't just download it and keep it. You have many apps in your mobile. Okay, just tell me, everyone, how many total number of apps you have in your mobile? How many? If you don't even know the numbers, even I don't know. How many of these apps have you watched? Do you watch regularly? I know you watch only WhatsApp regularly, only WhatsApp, tick, 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 and some other one or two more. Nothing else. Okay? Somebody might be watching that shopping apps, Amazon and all those things. That's okay. But remaining apps, we just download it and keep it. Don't just download it, use it. Go through it. What are you getting? You're getting many free features over here. Of course, paid classes are there, but free features also, free tests you are getting, free books you are getting, free classes you are getting. So download it and start studying. Okay. Country risk is an example of market, credit, operations, and liquidity risk. So country risk is an example of what? It is a part of credit risk. See here, credit risk always is of two types. Always remember this, two types. Okay. One is country and second is counterparty. I'll just write it. Okay, full only I'll write it. Counterparty. Because many of the students might not understand this. Short form of this is actually CP. Okay. But counterparty risk. So country risk and counterparty risk. Credit risk always has two parts. Okay. All of the following are types of price risk except, now again we want except means not, which is not the type of price risk. So all of the following are the types of price risk except commodity price, exchange rate, stock price, counterparty risk. Just now I gave you. What is the answer? Just now. Yeah. Type fast. Just now I gave you. Yeah. This one. Look at this. Credit risk has two parts, credit and counterparty, country and counterparty. So counterparty will be a part of what? Will it be a part of price risk? No, it is a part of credit risk. So this is credit risk. This is not the one. This is yes, this is yes, this is yes. All these are price risks. But this is the part of credit risk. Okay. In financial market, bond prices and yields are JIB studies. Okay. Bond prices and yields are inversely related, directly related, inversely or directly depending on the type of the bond, and none of these. JIB. Okay. Give me the answer. Yes, it is. What? What is the answer? Bond prices and yields. Inversely, right? If the yields go up, what is yield? Yield means asking rate. If the asking rate of any bond goes up, the price of that bond will go down. Everyone, just now I told you that join our Officers Adda 24/7 YouTube channel. But how to join it? Sure, we are having 3 important channels. One is on Telegram, second is on YouTube, and third one is on Instagram also. Scan this QR code. For this blue one for this Telegram, this black one for this YouTube, and this one for this Instagram. Immediately pause the video, scan this. Now, why should you join here? We gave whatever is available. What is available on these channels? Free tests, free ebooks, free classes. Okay. Then paid classes are also available on the app. So scan it and join. Whatever is free, grab it fast. Okay. These numericals we have already done yesterday, so I won't repeat it today again. Okay. Everyone, here, just to give you, yesterday we had done this numerical. Just for your idea, as I told you earlier, follow this again. Very important case study was there. Okay. So everyone join the revision batches. Okay. Okay. And importantly, this is Sankalpa batch. Join that was for JIB. Join the Sankalpa batch immediately right now over here. Okay. Because in Sankalpa batch, let me show you. Go to Adda 24/7. Your foreign correspondent bank is maintaining a Nostro Rupee account with your bank. It wants to fund his account by purchase of rupees 30 million against USD. Assuming the USD INR interbank rate as 75.2552650, what would be the rate quoted to the correspondent, ignoring the exchange margin? Calculate the amount of USD you would receive in your USD Nostro account if the deal is struck. Now look at this. This question has almost 3 to 4 various questions. 3 to 4. Okay, what are the various questions here? Firstly, understand the numerical, what it is. Your foreign correspondent is maintaining the Nostro Rupee account with your bank. So let's say this is Citibank. Okay, Citibank USA. So this Citibank USA is maintaining a Nostro account with your bank. Let's say you are SBI. Okay. So Citibank is maintaining a Nostro account with your bank. Now type in the comment section, what will this account be called as in the books of Citibank? Means Citibank will call this account as what? Nostro or Vostro. Type that. Citibank will call this account, because Citibank is maintaining a rupee account with SBI. Here it will maintain the rupee account only with the SBI. So this rupee account maintained by Citibank with SBI will be called as what? In the books of Citibank. Everyone fast. It will be called as, yes. In the books of Citibank, I am asking. In the books of Citibank. So it will be called as Nostro. In books of Citibank, it will be called as Nostro account. And the same account in the books of SBI will be called as what? The same account in the books of SBI means here Citibank is maintaining account with SBI. So it is your account with us. So that account will be called as what? This will be called as Vostro in case of SBI. Remember, Nostro and Vostro are not different accounts. They are same accounts. Okay, same account. Only from whose angle are we looking at it? That's important. So here Citibank, this will call this account as Nostro and SBI will call this account as Vostro. That's why it said correspondent bank is maintaining Nostro Rupee account with your bank. So you are calling this as Vostro. Now it wants to fund his account by purchase of rupees 30 million. Understand this properly. Purchase of rupees 30 million means what? Rupees is purchased. So what is going to Citibank shares? Whenever you purchase a vegetable. So purchase of vegetable means vegetable goes to you. Now who is purchasing it? Citibank is purchasing. So rupee will go to Citibank. Citibank wants the rupees. So if Citibank wants the rupees, what will Citibank have? See here, it's in USA. So it will have what? Dollar. It will have dollar over here, dollar. So Citibank will give dollar and receive rupee. Logic is clear? Citibank will receive rupee and give dollar. Got it? Clear? Now how much rupees does Citibank want? Citibank wants 30 million. 30 million. Okay. So here Citibank is requiring 30 million over here. Got it? What is 30 million? Understand that also. Million. What is 1 million here? US system is very simple. I'll tell you. Thousands. They have simple rule. 1000. Then what? Million. Then what? Billion. Then what? Trillion. And then last one is zillion. But forget this zillion. So 1000 means 3 zeros. 3 0. I'll just write it zeros over here. How many zeros? Okay. So zeros 3. Million means 6 zeros. Billion means 9 zeros. And trillion means 12 zeros. And zillion means 15 zeros. Okay. So you generally require up to this only. What? Billion only. This. Okay. So when I said 30 million, it means what? 6 zeros. So 30 and 6 zeros. 1, 2, 3. 1, 2, 3. So in Indian method, we will be calling it this, and this. Okay, it will be called as what? Lakh, 10 lakh, 3 crore. Yeah, 30 million. No, yeah, correct. 3 crore. So rupees 3 crores. Now understand this. What are you doing? See here, 30 rupees, 30 million is going out. So dollar is coming in. So if dollars are coming in, what will we do? Will we buy or sell? Now look at this important part. Whenever dollars come in, everyone understand this, huh? Whenever dollars, have I written it here? No. I'll just draw a line over here because my video is up to this part, right? So whenever dollars come in, whenever they come in, okay, in. So we'll always use the buy rate, buy. Okay. What is the buy rate? Now look at this rate. 75.2550, 2650. So always remember, whenever you write the rate, whenever you take this right side, that is always known as the sell rate. And this side is always known as the buy rate. Okay. So here we'll be using the buy rate. Why? Because dollars are coming in. Now what is the rate given? The rate given is this 75.2550. We'll take it now, right? 2550. So now what do I want? Look at this very properly now. Very important part. Huh? So $1 equals to rupees 75.2550. This is the rate. So $1 equals to rupees 75.2550. Now what do you want? What do you have actually? You have rupees or dollars now. You have this rupees 30 million. So rupees, I'll just write 30 million below the rupees. So 30 million over here. Okay, I'll just write M over here now. Million means 6 zeros. Understand this. Now what do I want then? What do I want? I want this rate. Dollar I want. What are the two questions? See this. The main two questions are calculate the rate. What rate would be quoted to this customer? Ignoring exchange margin. So there is no exchange margin over there. So that's why whatever rate has come, you will directly give him. What is the rate to be given to that customer? The rate to be given to that customer is this 75.2550. This is the rate which will be quoted to the customer because we don't have the margin. Whenever you deal with the margins also, then what you have to do, you have to either add or subtract the margin. If you do the sale transaction, you'll have to add the margin. If you do the buy transaction, you'll have to subtract the margin. But now, no margin is given. So no margin, I'll write it over here. No margin. No margin means what? Whatever rate is given, take that only. So this rate only I'll take now. Clear everyone? Type yes in the comment section if it is okay up till now. I'll take some water now. So is it okay now? Up to this part? Type in the comment section. Okay. Done? Chalo. Now next. So what do I do now? 30 million. I want dollars. How do I do? Cross multiply this. So what will I do? 30 million divided by this rate 75.2550. 75.2550. This is the only rate now. Otherwise what happens? We'll go ahead. 75.2550. Correct. Okay. So 75.2550. 30 million upon 75.2550. So do it now. Everyone do it in the comment section. I want the answer. 1, 2, 3. 1, 2, 3. 6 zeros, right? Upon 75.2550. Now give me the answer. Everyone. Give me the answer. Everyone in the comment section. I'll also try by that time. 30 million divided by 75.2550. What is the answer you are getting? Let me see from your side. I've got the answer. What is the answer you are getting? Everyone. Fast in the comment section. Let me see. Yeah. In the comment section. Yes. 398,644. Correct. 398,644. Okay. 0.6. So this is what currency? Dollar or rupee? This is dollar. Okay. This will be dollars. So dollar 398,644. This much dollar will be getting. See, the question is over here. Calculate the amount of USD you will receive because dollars will be coming in. So you will receive these dollars. Okay. So you will be getting these many dollars. 398,644. And the rate quoted to this customer is this 75.2550. These are the two answers. Okay. In exam, they might ask you various questions on this. They'll ask you this question also. Whether this account is called as Nostro or Vostro. They'll ask you various questions on this. Means they'll be asking you 30 million means this exchange margin. If it is subtracted, means if there is an exchange margin, then what do we do for buy for sale? They can ask you various questions on this. Okay. So that's why, is this numerical clear to everyone? Is this numerical concept and the logic plus the calculations clear to everyone? Type yes in the comment section. Okay. I will move to the next one. Before going ahead, subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates from IIBF on JIB and CAIIB. Number 1 means IIBF gives various notifications. Various. Change in subject, change in timing, change in venue, change in this, that, many things. So all are immediately updated over here. Okay. Secondly, you get the free YouTube series. What is the free YouTube series? Right now you are watching the same free YouTube series, Sankalpa series. So similarly, you get it on all the subjects, all. So that's why subscribe to it right now. Click on the bell icon, share it with your friends, click on the like button. Okay. Move on. Messrs. BCD wants to remit JPY 100 million by TT value spot as payment of an import invoice. Given if USD INR rates are 75.2500, 2600 and USD JPY rate as 116.5060, margin of 0.15% is to be loaded on the exchange rate. Calculate the rate to be quoted and the rupee amount to be debited to the account of Messrs. BCD. Now understand the problem correctly. What the problem is. There is some customer called as BCD. Okay. BCD. This customer wants to remit JPY. Remit means what? This is BCD. This BCD wants to send JPY outside. Send. So JPY is going outside. JPY is written is like this. Yen. Okay. So we'll be writing only Y now. Okay. Because all these things difficult. Okay. So JPY is written as like this. So BCD wants to send JPY. How many? So 100 million, 100 million. These many JPY this guy wants to send. Now if this BCD wants to send it, how will that person send it? That person will send it through your bank only. How will that person send it through your bank? The person will approach your bank and you will debit that customer's account. So look at this. If yen are to be sent out, does that customer have yen? No. That customer has rupees. That customer is having an account with you in rupees, right? Rupees account is there with you. P. With, let's say, SBI again. Let's say you are in SBI. Okay. So this customer is having the account in rupees with you. Okay. So what will you do? This customer wants to send this JPY over there. So you will, SBI, you will send JPY over here. You will send it yen, right? But when you send yen to someone else on behalf of this customer, you will debit this BCD customer, right? You will be debiting this customer by rupees. By what amount? You will debit rupees to this customer. By what amount? That is the only question. So how will you do it? See here, firstly understand JPY is to be sent out. So remit means you are using the buy rate or sell rate. Tell me first. Buy or sell? Buy or sell rate? Everyone. It's a outside dollars or other currencies going out. Whenever other currency is going out, we will always be using sale rate. So here we are using sale rate, right? Here we are using sale rate. Got it? Sale rate we are using. So what is the sale rate now? Look at this. Import. Here it's a import invoice. So import means always dollars or other currencies going out. Okay. So what is the sale rate now? See here. Look at the sale rate. 75 point. Should I take 25 or 26? Everyone over here. Should I take 25 or 26? I'll be taking what? 26, correct? I'll be taking 26 here. Now what am I doing over here? Look at this. I want JPY. I want to send JPY. So I want the rate of JPY to rupees. So always, what do I want? JPY to rupees. This is the rate I want. But do I have JPY to rupees rate? Look at this. USD to INR I am having. USD to JPY I am having. But I am not having JPY to rupees. So how will I do it? So the JPY to rupees will be using the chain rule now. Chain rule remembers everyone. Chain rule, you had it in your JIB also. You remember the chain rule? Chain rule means what? Here, JPY to rupee I want. So what will I do? I'll bring in a currency in between. JPY to dollar into dollar to rupee. See this, dollar can get cancelled. So again it becomes JPY to rupee, same, right? So here I am bringing in dollar in between. Now do I have these rates? Check this. Let's check this. What am I having? This dollar to rupee. Look at this. Dollar to rupee. This I am having it. Why? USD to INR. See this. USD to INR. Dollar to rupee. I am having this. So this is what rate? 75 point. Give me 75.26 sale rate, right? Because I am selling it. Do I have JPY to dollar? Check this. I am having dollar to JPY. But I want what? JPY to dollar. So what will I do now? It's reverse, right? So what will I do? First thing which will I do is, I'll first take what? Let me first draw this line here. Otherwise what happens? It goes behind me. So what will I do? I'll have dollar to I'm having what rate? Let me see. We are having dollar to JPY. So what is the dollar to JPY rate which I am having? Dollar to J, I'll write it. Dollar to JPY rate is what? Which I am having it. 116.50 or 60? Everyone. 50 or 60? 116.50 or 60? What is it I am having? What should I take? I'll take 116.60. Sale rate I want. Sale. Okay. So if dollar to JPY I am having, and what do I want? I want JPY to dollar. See, this is what I am requiring. So if I reverse this, what is the rate I will be getting? So JPY to dollar will be, I'll reverse this also. So whenever nothing is below, it means it's 1. So I'll be using 1 upon 116.60. Right? So JPY to dollar is 1 upon 116.60. Now what do I want? I want JPY to INR. So both the rates I've got now. So now my JPY to INR rate will be, look at this, JPY to INR rate will be, what was that? JPY to dollar into dollar to rupees, right? Dollar to rupees, right? This is the rate, just now we saw it. So JPY to dollar rate is what? Equals to 1 upon, look at this, 116.60 into this dollar to rupee. Now dollar to rupee, just now we got it, 75.26, this one. Okay. So 75.26, do it. 75.26. So give the answer. Bring it in points, okay? 75.26 divided by 116.60. Divide it, everyone. Everyone, yeah? So I'm getting it as 0.645, right? 0.645. So 1 JPY. So what is this rate? JPY to INR, right? This is what I want. So what rate will you be quoting to that customer? Calculate the rate. Now, but see here, there is a margin also involved over here. And I'm doing an import sale transaction. So for sale, what do we do? Margin. Firstly, what is the margin rate? Margin equals to, what is the margin given? 0.15%? Yeah. 0.15% of this rate, of this 0.645. So what is the answer? Do this. 0.645 into 0.0015. 15% means 0.0015, right? So it is it's very less, isn't it? 0.00009 something, right? 96, very less. Okay. So what do I do with this margin? I'll add this or subtract this. I'm selling, right? Selling. So whenever I'm selling, I'll add this. So what is my rate now? So rate equals to 645 plus 0.00096. So give this rate, add this, it becomes what? 0.645, very smaller rate, okay, this much. This is my final rate. So what is the question asked? What rate? Calculate the rate to be quoted. So this is one question, rate to be quoted. And second is rupee amount to be debited. What is the rupee amount? So what is the rate over here? This is JPY to INR. So 1 JPY equals to what? 0.64596 INR. But what do I want? Do I want INR or JPY? I want what? 100 million JPY. So I want 100 million over here. 100 million JPY. So I'll write this below JPY. Now what is the question mark? Question mark is over here. So what will I do? I'll cross multiply. So how many rupees will I be debiting to that customer? Rupees equals to 100 million into 0.64596. Multiply this. What here? This will be around. Okay, let's do it here. It's very difficult. Means these calculations. 1, 2, 3, 1, 2, 3, right? Into this. Whatever this same rate over here. What is the rate over now? Now how many? 1, 2, 3, 4, 5. Remove 5 zeros from here. So it will be 6. What this 100 million into this? So it will be 64596 and then 3 zeros from here, right? 3 zeros. 1, 2, 3. Yes, 1, 2. So it will be 64 million. This much amount I'll be debiting to this customer in rupees. So this is the amount debited to the customer. If they ask you in million, it will be rupees 64.59 million. This much amount I'll be debiting it to the customer. Okay. Difficult one. Not that simple case study. Case study is very difficult. This one. So that's why I'm saying follow the series completely, because I'm taking very important numericals over here. Okay. If USD to INR rate is given as 48.10 and pound to USD rate is given as 1. What is the rate of pound to INR? Now, what is this? What is it to be used? We are using what? Over here, we'll be using chain rule, right? Chain rule. What is the chain rule? When you don't know the rates of any currency vis-a-vis your local currency, okay? Means this pound to INR. If you don't know the rate, do you know the rates of pound to INR over here? No. But you are having the other rates, means some base currency rates you are having. So what do? We use the chain rule. What is the chain rule? We use it like this. You have pound to, what do you want? Say this, pound to INR. I'll write it P to I. Okay, let's keep it simple, P to I. So it will be what? Pound to USD into USD to INR. Chain rule, you have studied this in your CAIIB also. So pound to USD rate is what? 1. So keep it 1 only. USD to INR is what? 48.10. So the answer will be 1 into 48.10. Okay? So D is the answer. Isn't it? Simple one. Next one. Chalo. If USD INR rate is 48.10, USD JPY rate is 91.50, what is the rate of INR to JPY? This is not simple. Calculate the rate for 100 JPY. Remember, JPY is always, JPY means what? Japanese yen. I'll write it. JPY means Japanese yen. Okay, it is their currency. So Japanese yen is always calculated in terms of hundreds. We always calculated 100 JPY, 200 JPY, 300 JPY. Rates are quoted in that angle. Why? Because the currency is very small. Now it doesn't mean, remember, the currency is lower. It doesn't mean the country is lower. Japan is the most developed country, one of the top 5 developed countries in this world. Okay. So once you have this top 5 developed countries and their currency is lower than that of Indians, you'll say then it is less developed than India? No, nothing like that. Currency is not at all related to the development of any country. Okay. So now, Japanese yen. Okay. So what is the rate now? You want what? INR to JPY. See here, it is INR to JPY we wanted. INR to JPY. I'll write it J over here. Okay. So again use the same chain rule. INR to USD. USD into USD to JPY. So are you having both the rates? INR to USD. Are you having INR to USD? See here, USD to INR rate is given. INR to USD into USD to JPY. This is what you want. So how will you do this? See here, we always, when I am saying this INR to JPY, I want this rate, and JPY to INR. See here, it's actually reverse one. Whenever we find this rate, we find it this way. JPY to INR. This is what we find out. And then JPY to USD into USD to INR. This is what we find out always. So now first find out this. If you want, you can reverse this. If they ask you in INR to JPY, you can reverse this later. Because this rate is difficult to find out. This rate is very simple. So JPY to USD, what is the rate? JPY to USD. And USD to INR, you know it. See here, this is 48.10. And this JPY to USD is, you don't know. This is 91.50. But that is what? This is USD to JPY. So that is 91.50. So if I want JPY to USD, this is upon 1. So if I want JPY to USD, it will be J upon U equals to 1 upon 91.50. Okay, that will be the rate. So now I've got the JPY to USD rate. Multiply this, put it over here. So my answer will be 1 upon 91.50 into 48.10. Okay, so what is the answer now? Do it on the calci, everyone. Try it on the calci. Yeah. Let me see in the comment section. Let me get the answer in the comment section. Everyone, give me the answer in the comment section. 48.1 divided by 91.5. Okay. So it is 0.5256. 0.5256. 56. Now this is for what? This is JPY to INR. Okay, JPY to INR. But they want it for what? 100 JPY. So multiply this by 100. So it will be 52.56. Where's the answer? Check this. 52.40 or 80. They'll give you this 56 answer, or 50 they'll give you. 60, let's take it. This will be around this 60. So 52.60 roughly. 56 and 60. In exam they'll give you the exact answer over here. So it will be 52.60 or 56, whatever this rate is. Okay, got it? Always do it for hundreds. Got it? JPY is always calculated in terms of hundreds. When the exchange rate is fixed by monetary authority of India, of any country, it is called as. Here, when it is fixed by the monetary authority, means what? RBI tomorrow says that dollar to INR rate, okay, is, let's say, 70 rupees, fixed, no changes in that. It will not fluctuate. It is fixed by this monetary authority. So in this case, what is it called as? Direct, indirect, floating or fixed? Direct, indirect, floating or fixed? It is called as fixed, isn't it? It is fixed by the monetary authority of that country. So it is fixed, but obvious. See here, these things are done in many of the countries. Like I'll tell you, there is huge interference in the currency by many of the countries directly. I'll tell you where. China. If you check China, their currency is what? What is the currency of China? Anyone can give me? What is the currency of China? It is yuan, right? Yuan. Main currency, there are renminbi also, but main is yuan, right? China interferes a lot in their currencies. It is administered rate, you can call it. Means administered means it is administered by the government, direct interference. Whereas in India, it's not fixed by any RBI or anyone. It is based on demand and supply. China interferes in this currency, and if it wants, it can reduce the rate. If it wants, it can increase the rate whenever it wants, whenever the government decides. So this is known as this interfered rate. So it is fixed by, they say that yes, we are also free floating currency, but nothing like that. Okay, it is fixed. Got it? Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates from IIBF on JIIB and CAIIB, various notifications. Change in timing, change in subject, change in this. They give this now during the exam days. IIBF gives many notifications. So all of them you get it immediately on Officers Adda 24/7. You need not go to that IIBF website every now and then. Okay. So, and secondly, free YouTube series. Right now, what are you watching? You are watching the free YouTube series. So similarly, you'll be getting the free YouTube series on all the subjects of JIIB and CAIIB, all of them. Okay. So subscribe to it right now. Click on this bell icon. Share it with your friends. Very important. Okay. Bell icon is important so that you get the notifications. When the exchange rate is fixed by the market demand and supply position, it is called as market demand and supply position. Means whatever, if your demand is high, your rate goes high. If your supply is high, your rate goes low. Do you know this concept? Suppose if demand and supply means what? If the demand for dollar goes up, demand for dollar, let's say it will go up. If it goes up, then what happens? The rate for dollar becomes what? The rate for dollar will be high or low? Give me. Will it be, just type H or L. Will it be H or L? If the demand for dollar is high, will the rate for dollar will be high or low? It is high, correct? So if, see, our logic is very simple. If the demand for any commodity is high, the rate for that commodity will go up. Right? This happens, when does this happen? This happens when you have huge fund flows coming in. Suppose if in India, there are large amount of dollars coming in, large amount. Everyone is investing dollars, okay? Large dollars are coming in. Then what will happen? In that case, the supply will increase, supply, okay? Supply will go up. If supply goes up, then what happens? The rate goes down. So the dollar rate will go down. right? So when large dollars come in, supply goes up, supply of dollar goes up, and the rate goes down. And vice versa. If the dollars go out of the country, if all the investors are moving out of the country, so dollars are moving out, then in that case, dollars are moving out. Okay? If dollars are moving out means what happens? There is a less supply of dollars in this country. Then the rate will go up. So what is this called as actually? Whenever it's decided by this demand and supply position, it is called as what? Direct, floating, indirect or fixed rate. It is called as floating rate. Correct? It is called as floating rate. Remember. Fixed and floating, these are the two main rates. What is this direct and indirect? Direct and indirect rates are also there. What do we use in India? So if I say $1 equals to 80 rupees. So what is this now? Is this a direct rate or indirect rate? Type in the comment section. Is this a direct or indirect? Give me the rate. Direct or indirect? What is this called as? It is, what do you say guys? Direct or indirect? It is called as direct rate. Direct. Whenever your dollar, remember, it's the logic is simple. Your dollar is fixed and your rupee currency, local currency is fluctuating. It is called as direct rate. Indirect is reverse. Suppose if I give you £1 equals to $1.5. So here what is happening? Dollar is fluctuating. So this is called as indirect rate. When your dollar is fluctuating, it is called as indirect rate. Okay. So now remember, we in India should move out from this rate to this rate system, because we must develop ourselves so big that we must also have this indirect rate system. Dollar should fluctuate and rupee should be stable. Right now it's the reverse thing. But although now again I'll tell you, don't confuse yourself with the currency, because if you look at it, pound is now having the indirect rate. Okay, but pound is having what? Indirect means what? Is this economy bigger than that of India? No. Indian economy is bigger than that of this Britain economy or London economy. Then also they are having this indirect, because these rates were fixed long back. That's why they are still prevailing. Now within few years this will go. This won't remain for long. So, because if the pound is not growing, if the country is not growing, will this indirect rate remain? No. US will say no, forget this. Make this pound also in the direct rate. And in coming years, if we grow with such a speed, there will be a time when our direct rate will be converted to indirect rate. We will be the governing power, because we are already planning for growing to third number of the economy, right? We are right now at fifth and we are moving towards the third. So when we move towards the third, these rates will change. Okay. So this is got the concept of direct, indirect, floating and fixed, right? The term bid rate stands for bid. Bid means what? Bid rate. Bid offer, bid offer. Okay. Bid offer. It's like this. Bid offer. So you call it buy and sell. Buy and sell. So bid stands for direct, indirect, buying and selling. So it stands for, isn't it? Buying rate. The selling rate of a foreign currency offered by a bank is called as, just now we did it. Selling rate, sell rate is known as what? Yes. Give me in the comment section. Just now we saw it. Yeah, this one. Sell is what? Correct? Type fast. Offer. Isn't it? Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we need for clearing this JIB and CIB, we'll be getting it over here. So that's why download this app immediately and start studying. Don't just download. Okay? Start studying. Country risk is an example of market risk, credit risk, operational risk, and liquidity risk. So country risk is an example of what? Yeah. It is credit. Okay. Remember, credit risk is of two types. Credit. Mainly. There can be various types, but mainly two types. Okay. One is country and second is counterparty. Counterparty. Okay. What do you mean by this? Credit risk, country risk means what? Your party is good, means A is selling to B. Let's say A is selling the goods to B. Okay. So B is good, but a country in which B is living is bad. Afghanistan, North Korea. So B is good. But the second part is counterparty. Here B is bad. Country is good. USA, somebody staying in USA, somebody staying in Europe. Countries are good, but the party is bad. So that is counterparty. So country risk is an example of what? Credit risk. Isn't it? All of the following are the types of price risk except, so which is not the type of price risk. All of them. Let's see. Price risk means what? Commodity price risk. The price of any commodity. What is the commodity? Commodity is anything. Dollar is also a commodity. Okay, currency is also a commodity. So commodity price risk. Exchange rate risk. That is also price risk, because if the dollar rate changes or the exchange rate changes, definitely the price will change. So this is also the part. Stock price risk and counterparty risk. Now it's typical one. Counterparty is what? Just now we saw it, credit. So is it a part of price risk? No, isn't it? So this is the answer. So these all are true, 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 and this one is false. And we want false only, which is not the type of price risk, right? Stock price risk, obviously, stock price risk is a part of price risk only, isn't it? In financial bond markets and in financial market, bond prices and yields are. So this bond price and yields are what? Directly or inversely related? Inversely, directly, inversely or directly, depending on the type of the bond. None of the above. So the bond prices and yields are always. They are always. Once remember the price of the rate of interest, yield we call it. Yield means what? It's the rate of expected rate of interest. Here, what is yield? You need to understand that also. Expected rate of interest, expected ROI. Okay, that is yield. There are two rates always in any bond. One is coupon and second is yield, right? So coupon is always fixed. Once it is given, it's fixed. You can't change it. But this yield goes on changing. Expected rate goes on changing. If the expected ROI goes up, then the price of your bond, existing bond, will go down. Always remember. If the expected ROI goes down, your price of the bond will go up. So it is what? Inversely related, isn't it? In financial bond market or market, bond prices and yields are inversely related. Always. You see this. What happened in this, October, just type on Google, October 22 to December 22. Check the US bond rates. US bond rate. Check this. You'll get this. In US, the prices of the bond fell like anything. Why? Because the rate of interest or the bank, their Federal Reserve, increased the rate of interest. So that was the point. Okay. Now, how to join this Officers Adda 24/7 YouTube channel or the Instagram channel or the LinkedIn channel? Scan this QR code. For this LinkedIn channel, scan this QR code, do one. For the YouTube channel, scan this black QR code, this one. And for the Instagram channel, scan this QR code. You can join it immediately. Okay? Because on these channels, we are giving free YouTube series, we are giving ebooks, we are giving tests, some of the sample ebooks, simple, some during the exams, we take various tests as such, free tests. So you can join this right now, isn't it? Rate of cancelling the original contract means whenever we cancel the original contract rate, it is done at what rate? TT buying, TT selling, bill buying, bill selling. Sir, cancelling the original contract rate, it depends on what rate are we talking of. Suppose I am calling buy rate. Rate of cancelling the buy rate. Okay. So if I have purchased this dollar earlier, okay, if I have purchased it, I might have purchased it at what rate? I might have purchased it at either bill buying or TT buying, depending on what type of transaction it was. If it was a Spot transaction, I might have done it at TT buying. If it was a bill transaction, I might have done it at bill buying rate. But cancelling is always done at the same rate. That is known as TT selling. Cancelling, here, cancelling means reversing that transaction. So that will be always done at TT selling. Rate of booking a new contract for next 1 month is TT buying, TT selling, bill buying, bill selling. Here, next 1 month I want. So just now I told you, spot transaction, spot will always be done at TT. Whereas future transaction will always be done at bill. Okay. So it will be done at a bill rate. But bill means what? Booking new contract for 1 month. Which contract? Suppose if I say export contract, export. So export means what? Buying. So I'll be using bill buying rate. So I'll be using bill buying over here. If it's import, then I'll be using bill selling rate. So next 1 month export, the question is given, then you'll be doing it at bill buying rate. Okay. Everyone join this the batches now. See this. Let me show you the batches directly. These were JIB batches here. Go to Adda 24/7. Everyone. Let me take you to Adda 24/7. Always I would suggest you to go through the app. In the app, what happens? You get the coin systems. This coin systems will give you 1% extra.